Hello, traders and colleagues. Welcome to our course on the basics of finance. My name is Yaroslav, and I'm happy to greet you today. Today, we have a great course on different types of analysis, and we'll dig a little bit deeper into technical analysis. Now, market analysis helps us to interpret and predict the future behavior of an asset or a market. Now, there's three types, most commonly known, of forms of analysis. The first one being technical, second one being fundamental, but there's a third one that you may have not known of before, and it is the analysis of sentiment, basically what people feel or what they are doing actually. There's a lot of arguments concerning which one is better, which one is needed, which one is not needed, but to be a holistic trader, to be a successful, I believe, trader and investor, you should at least know about all three, which we are going to teach you today. Now, technical analysis, there's three types of popular technical analysis. They involve using a line on a graph, bars, which is the US standard, or candles, which was originally developed in Japan when they used to, in the rice trade, they used to have candlestick charts that showed different volumes of rice. They're ways of showing price activity, basically. Now here, the first one, a line chart or a zone chart, as we have it on the Olymp trade system. It's the simplest form of chart. It connects closing points together on an x-axis and a y-axis, and over the course of a trading period, basically. The one that we have here on the screen is a 1 hour time frame of Brent oil. Moving on, this is what a bar chart looks like. Now, besides just showing a close price, this chart actually shows us four things. This shows us the opening, the closing, and where the price was highest and where the price was lowest. So this gives us a little bit more data on top of color. Pretty simple, don't you think? Now, let's discuss this a little bit more in detail. Here are bar charts of a bullish direction and a bar chart of a bearish direction. Now, they're not color-coded, so it's not that easy for you. But basically, here we have the opening price for whichever trading period, say an hourly time frame. Here, the one to the right, the little line to the right, that's the closing price. And the lower trading period and higher trading period. How we know this is a bullish candle, that the opening price is lower than the closing price. So we started off and closed higher. That is an upward movement. Pretty simple, right, guys? Same thing for a a bullish, bearish candle. Opening price is higher, closing price is lower, but before the period finished, before 1 hour was up, we dropped down significantly lower, which is indicated right here with the tail end of the bar chart. So that's how we can tell different market movements happened in a time period, and we can gauge a little bit of what traders are thinking or what has already happened. Now, this is the most popular form of charts because it has the most amount of information, basically the same as a bar chart, but it's just a little bit more easier to comprehend because the space between the opening and closing of the candlestick is filled in. So it takes a lot of the guesswork out, and it shows you very easy when you have a candle like this, a doji candle, which basically shows undetermined movement. That's easier to spot with this kind of chart. Exactly the same as a bar chart, just looks a little bit more appealing, a little bit more easier to understand. Here we can discuss a little bit in detail what a candlestick looks like. So a bullish candle with the body that's white going up. Here we opened the opening price. Here's the closing price. It went a little bit higher, went a little bit lower before it closed. Same thing with the bearish candle. Here we opened at this level here. Then we dropped down some, we went up some, and ended up closing again here, thus drawing a bearish candle. In general, they're more graphic and the visual perception of them is easier. Now we get into a little bit more fun and interesting things. Resistance and support levels. Now, why is this interesting, you say? Because everybody uses it and it works. It's like the magic Fibonacci numbers. So support and resistance, keep in mind, they are just areas. There is no scientific way of saying that, 0.01 area is the resistance. In fact, a lot of market makers will spike through resistances or supports called a liquidity grab or a bullish trap or a bearish trap. So basically, this is how you draw support and resistance points. Something that, can't get past a certain level, there's resistance to it. If something doesn't fall, just doesn't fall the 114 line, let's hypothetically say, that's a support zone. And the time frame that a support and resistance zone can play for can be years. On the Forex market, lows and highs of a particular currency, they can be in play for years. So when the price returns to that level, it will immediately fade. It will immediately withdraw and retrace back because traders know that that is a zone of support or resistance. If price still stays below that level, it is valid. I think it is also true to say that the more a resistance or support level is tested, the weaker it becomes, right? The closer the price is to that level, the more of a probability that that level will soon be broken. Now, like I said, these are really important tools that are used by everybody. So please learn how to effectively draw your support and resistance levels on your graphs. Here I drew the support and resistance levels on the S&P 500. That was at the end of the last year. Indicating how this level of 28.21 was a resistance level. And here we had beautiful support levels at 26.20 until what? That's right, until it was broken. Now, see how it was it was broken with lots of velocity, lots of speed behind it. If you can measure speed in the markets, basically the reason I say that is because these green candles were very few and far between. So normally with a break of a level like this, we would have a retest, which is where I would enter with my trade strategy because I have a break and retest entry level strategy. But basically that's how it looks like on a graph for you. Now, some things to remember. This information is very valuable, so you would do best to write it down. When price breaks a support level, it could retest it. And in that sense, it reverses its role and becomes a resistance. It's true the other way around. Now, like I said, the more price tests a level, the weaker it becomes. Everybody who wants, the reason that happens is that why does price stop at a resistance or support level? This is for you guys to understand. Because somebody at that level is buying up all of the bids or offers. Everybody who wants to sell, one or two or a group or a conglomerate is buying everything at that level. Sooner or later, their money will end or their goals will change. So sooner or later, those buyers will no longer be there. And when the price returns to those levels, it'll fall right through. So that's the reason that the more we test support or resistance level, the thinner and the more ready it is to be broken. Now, the longer some level holds, the stronger the move could be after, because all this time somebody was there acting as a buffer. As soon as the level breaks, we could have a huge storm into the direction that we were broken in, which we saw with the S&P 500. It was being held, and see how this time price poked through. And if you notice, let's do some candle analysis. See how these have really long wicks but very short bodies at the bottom? Those are called hammers or flying stars, falling stars. So those are all chart patterns, candlestick patterns that indicate we're going down. It's going to be bearish. So there were actually a few days, if you traded futures S&P, that you could have gotten in on a very sweet trade to go down. And the longer your time frame, the wider your support resistance level is. I usually put up my support and resistance levels on the weekly time frame and sometimes the daily time frame. But no matter what chart I'm on, I always have support and resistance levels, and I also have channels, which we will go through in just a bit. Now, I wanted to give you guys a treat, something special. This is a way of drawing out your candles that signify a certain market movement. They are called Kanashii candles, or Olymp Trade provides a Kanashii chart. Very, very effective, very, very useful. So for those of you that are math geeks that want to know the reason for why for everything, it's more of an indicator, and the math behind it is open levels. So the opening part here in this candle, the opening is right here, is the closing of the previous candle plus the open divided by 2. The close level here is the max price plus the minimum price plus the open plus the close divided by 4. So basically it rounds out the extreme points on the chart. A green bar without a tail is a good indication to buy. When you have 2 or 3 of them at the same time, that is an indication of a trend, and it's a good idea to jump in on that. On this chart, Ethereum Classic, there are 2 places that I would enter, maybe 3, mostly 2 because I know that cryptocurrency is in a downward trend. So obviously I want to eliminate 50% of my mistakes. So I'm going to be aiming down already in my head. And then I look at the signals. Here we have 3 or 4 red candles that have no wicks. By the rules of trading Kanashii candles, this would be a good entry point somewhere around here. Now later on we see some green candles, some more green candles, but they all have wicks or tails. Well, wicks in this scenario don't help us, but there's tails, so that really keeps us away from the trade. But then when we have some reversal candle and also some strong movements down without a wick going down, that is also a good signal to sell. So I just wanted to show that example to you guys so that you can go out there and try yourselves trading using a Kanashii chart. And like I promised you, trend lines and channels. Here on one screen, we put together the different market movements that we can see and also how to draw trend lines and channels. So basically, there's 3 ways the market can move. It can move up, it can move to the side, and it can move down. So it's all here for you on the screen. Now, the way you build a channel in any direction, you need 2 points together to build a channel. Support and resistance, you only need 1 point, right? You can have 1 top point, and that'll be the level that we watch out for. Whereas anytime we deal with lines and channels, you know from geometry that you need 2 points in order to make a line. So the 2 lines are here and here. This is an uptrend. Then I grab this uptrend, and then I just duplicate it on top, building a channel. Same thing here at the bottom. I grab 1, 2, 3 points. I build my trend line. It's going nowhere. I flip it over on top. This is a very important motion of flipping it on top, because then I know when price gets to that level of resistance, I know to be watching out for it. Okay, and that was a good indicator to buy. We broke through the level and continued upward. And this is what a downtrend looks like. Again, we have 1, 2. Downtrends are marked by their lower highs. Uptrend are marked by their higher lows. I know that's a little bit confusing, but you'll get used to it. Again, we know that we're going up when our lowest lows are higher than the previous ones. And we know that we're going down when our highest point is lower than our previous highest point, right? Logically, that's the way that it's built, and it's easy to remember as well. So we put these 2 points together, then we drag the line to the bottom, and we see a really strong breakdown. That was at the end of last year with the Dow Jones Industrial Average. Moving on, I wanted to tell you a little bit more about the properties of trend lines. Like I said, you need at least 2 points to draw a trend line. The steeper a trend line is, the less reliable it is, because think about it this way: everything that goes up must come down, and it's more probable that it will break sooner than later. Another great piece of advice I want you young traders to keep in mind: when you see something fall, and it falls a lot, like oil, do not expect it to come back up to the same price that it was for a long time. The reason being is, think about it this way: if somebody fell out of a 2-story window, how long would it take him to get back up, dust himself off, and get back up to that high place that he was at? How willing is he to get back up that high that he fell from? So think of the market also as an organic kind of a marketplace that's organic. So something that falls really fast for a really long time is not going to come back up, but there will be a bounce, there will be a fade, there will be a reversal, not a reversal, but a retracement of some kind. And you should never adapt a trend line to market behavior. Don't force something on top of a bunch of lines sticking out. That's not the way you want to do it. 1 or 2 lines sticking out is okay, but generally you want to gently place it on top of each other so that it kind of encapsulates it and gives you an idea of the boundaries. That's the reason we do these things. We look for boundaries, and those are the areas that we want to do business in. We want to deal in boundaries. We don't want to be in the middle where it's chaos. All right. And a few more things. Now, if the market has closed below or above an uptrend and holds for at least 3 periods, it doesn't matter, 3 5-minute candles, 3 hours, or 3 days, then very possibly that line is broken. The reason I say this is because there's a lot of false breakouts where one candle will shoot up, take out stop losses, then come back down, and that does not mean that the trend line is broken. Now, after a breakout, we already went through this strategy, usually with a 60% probability, the price will come back to that level, retest it as the opposite, like opposite of support or resistance, and then go on its merry way, continuing in the direction of the breakout. And in literature, I've heard this price action called a kiss goodbye. Real traders, I have not heard use that terminology, but just so you know, let's add a little bit of romance into our line of work. The longer a trend line is forming, the stronger the move could be after the breakout. We already talked about this. And another very important thing, longer trend lines, longer time frames always overrule what's going on in the short term. So the short term chaos, again, could be a 5-minute spike out, but on the hourly time frame is nothing but a wick or a tail. Okay, and this is a really key one I want to drive home. You guys listen carefully. If a line or a channel is blatantly obvious, be certain it is also obvious to the market makers. Those greedy guys that are sitting behind the curtains that want your money. And be sure that they are plotting on a way to scoop it. So the longer we have a trend line, the easier it is to spot, the bigger the temptation for market makers to press that trend line and to trigger all your stops and stop losses. So keep that in mind, you guys. So that's it for today's lesson. Thank you guys so much for your attention. Next time, we're going to go through fundamental analysis, the reason why behind all these movements. Thank you so much. My name is Yaroslav Burchenko. If you enjoyed the video, give me a thumbs up or a coffee, and we'll have a chat about the markets. Thank you so much. See you next time.